Good morning. You are watching a live market outlook for Friday, 3rd of February 2012, last day of the week, and the release of the most important figure that is due today, U.S. non-farm payrolls, with all markets currently moving in the rather narrow ranges and rather sideways, awaiting the final decision. Shares and euro were slightly lower during the Asian session, but kept its short-term positive tone as debt restructuring talks between Greece and the creditors dragged on, undermining sentiment, and investors sat tight, awaiting the US data to be released today. Also, most of the instruments were currently moving within a narrow range, awaiting the release that will give us more clues about future movements. The US employment growth is likely to cool in January, but the jobless rate is expected to hold at near 3-year low, consolidating a recent improvement in the labor market. Non-farm payrolls rose by an estimated 150,000 as the hiring boost from busy holidays shopping season unwound. According to the surveys, after jumping by 200,000 in December. The unemployment rate in US is seen holding steady at 8.5%, the lowest level since February 2009, after declining 0.6% point over the past 5 months. According to analysts, the underlying details should not be as soft as the figures would imply, and looking through the distortions, we believe the labor market is improving. Payroll growth in January was likely restrained by the loss of 42,000 couriers hired in December on the back of strong online shopping during the holidays. But outside transportation and warehousing, details of the report are expected to be fairly encouraging, with gains expected in construction and manufacturing. A raise in average hourly wages is also expected. The Labor Department will release the employment report today at 13:30 GMT. The employment report will be scrutinized for signs of weather and anticipated slowdown in U.S. economic growth in the first quarter is impacting on companies' hiring decisions. The sluggish labor market was one of the key factors that prompted the U.S. Federal Reserve to say it would probably hold interest rates near zero at least through 2014. It could also help determine whether President Barack Obama will be re-elected in the coming elections in the U.S. The Federal Reserve Chairman Ben Bernanke said yesterday he was seeing signs that some of factors dampening U.S. business investment, including uncertainty surrounding European bank woes, might be waning, but he kept the option of further easing on the table. From the Europe, Greece has kept hopes of a debt deal alive all this week, but has pushed back the actual debt swap agreement needed to secure a crucial second batch of funds to prevent Athens from defaulting. Eurozone finance ministers aim to agree a second financing package for Greece on Monday. A deal for Greece would include agreement on official new financing, the size of voluntary losses banks and other private bondholders are willing to accept, and new reforms that Athens must undertake. Despite their lack of progress in the debt restructuring talks, sentiment continued to improve in European debt markets as the effect of the European Central Bank's unprecedented funding provision in December filters through. Spain and France drew healthy demand for their debt sales on Thursday, driving their funding costs lower. That would be the highlights of past 24 hours and the outlook for today regarding the fundamentals. A brief look at today's calendar. First to come is the Eurozone final services PMI that is due at 9 o'clock GMT, so in approximately 45 minutes, and unchanged from previous release of 50.5 is today's forecast. Half an hour later at 9:30 GMT is UK services PMI, with today's forecast slightly lower than the previous month release of 54.0. 53.5 is expectation for today. At 10 o'clock GMT, Eurozone retail sales monthly growth of by 0.4% is expected today, compared to December's negative minus 0.8% release of Eurozone retail sales. The Americas start from Canadian unemployment rate due at 12 o'clock GMT, and expected to stay unchanged at 7.5%, with the Canadian employment changed, expected to show adding 23.3 thousand jobs compared to 17.5 thousand in the previous month release. The star performer today will be the new US non-farm payrolls that are due at 13:30 GMT, and as mentioned earlier, the forecast for today is 150,000 compared to the previous month release of December's 200,000. Unemployment rate in US is expected to hold at 8.5%, the same like December's reading. Also, the average hourly earnings on monthly basis expected to stay the same level at 0.2%. Later in the afternoon at 1500 GMT, US ISM manufacturing PMI. Positive forecast 53.1 compared to 52.6 of the previous month release. At the same time, US monthly factory orders 1.5% is today's forecast, and 1.8 previous month release. Now let's take a look on the markets and see the movements in the past 24 hours. As we can see, the euro, the near-term price action shows the pair still within the range, with the lower with the floor of the range at around 130.25, and the upside being capped by 132 and 132.32 previous high, and narrowing currently range and forming the hourly triangle pattern as markets are getting quite ahead of today's release. A wider picture on euro still keeps the positive short-term structure of 126.22 13th of January high intact. 38.2 Fibonacci retracement at 132.32, the same of the high of 27th of January 2012, keeps the upside limited in the near term. However, the further extension higher is expected as long as initial support at 130.85, 55 days moving average is holding, and the 20 days exponential one at 130.25 that currently maintains the latest rally. A break above 132.32 high to open next dynamic resistance, currently at 132.88. It's daily 90 days exponential moving average, and possibly to look for a test of 133 and further extension higher in case of break of 132.32. As I mentioned, the wider time frames are still in the positive mode. Near-term price action is neutral. The studies are neutral on the hourly. However, the 4-hour charts are still positive to neutral, and holding above initial support at 130.84, where is also a daily 20 days moving average, and needs to keep the focus higher, and the break above initial barrier 131.74, the triangle resistance, and the regain of 132 is required at this point to resume gains and break above 132.32 and continue the short-term uptrend. On the downside, strong support at 130.25, 130.00. This is our range floor, and Fibonacci 38.2% of the short-term uptrend, and the loss of these levels would be risky, might result in putting the short-term bulls aside and allow for a stronger reversal of the pair. The cable is also in a near-term corrective consolidative mode after a strong rally that surged through critical barriers at 157.70, 158.00, extended to 158.80 so far. The pair extended this morning slightly below 158.100, 157.84 low was seen so far. However, positive signal is two consecutive closings after breaking above 58, consecutive closings above 58. My signal fresh gains ahead. The near-term price action, the structure is neutral, rather neutral, as the pair continues to hover around the 158.00 level, while 4-hour structure is still in the positive field, as 20 days simple moving average currently at 157.96 holds the downside. Also important is channel trendline support currently at around 157.60 zone, a break of which would risk deeper correction, with the initial level to be tested on a break at 157.00 ahead of higher platform at 156.60-40 zone, a loss of which would be near-term bearish and would open way for a stronger correction of the short-term uptrend. This is also close to 38.2 Fibonacci retracement of the entire move from 152.33 to 158.80. For now, the upside remains in focus as a stable bull channel from 13th of January remains intact, and likely scenario would be break of 158.80 recent high to open next significant barrier at 159.00 as a figure resistance, and then 159.50, which is 200 days simple moving average, break of which to open way for significant gains higher. Dollar yen remains in a very narrow range, moving sideways in past 3 days after slumping from fresh highs at 78.20-30 zone, where the 200 days moving average limited the upside after the pair tested its one of its key barriers at 78.20-30 zone. This is November-December range ceiling. Failure to hold this triggered a sharp reversal with loss of 76.50, our strong medium-term support, extending so far to the next level at 76. This is the floor of August, September previous range, and the break here as the wider picture studies are still in the negative field and still pointing lower, would likely open way for a test of all-time low of the dollar yen at 75.56 and possible further extension higher. As shown on the daily chart, the studies are negative, while 4-hour studies keep negative tone and are currently in the negative to neutral mode, while the hourly studies keep the neutral mode, moving within very narrow range. Need to mention that Bank of Japan's possible action is still on the table, and further the extension below 76.00 might be a trigger for the Bank of Japan to intervene and stop further strengthening of Japanese currency. The dollar Swiss is also in the near-term range trading after unsuccessful attempt higher that cleared the two strong barriers at 92.08 and 92.27, stalled at 92.50, just ahead of 61.8 Fibonacci retracement of the latest downleg from 93.38. No significant changes from yesterday's update as the pair further narrows the range, and maintains the short-term neutral mode, moving within now narrower range of 91.30 and 92 zone, with the break either side and the break of more significant range floor at 91.13 and the range ceiling at 92.50 to define the further movements. Daily outlook, however, maintains a negative structure and keeps the downside favored as the studies are below their center lines, and widening Bollingers on the daily chart suggest further easing. Currently, the 90 days moving average at currently 91.87 caps immediately the upside, with the loss of 91 to open the next level Fibonacci 50% at 90.75, ahead of 90.00 psychological support, and 89.55 Fibonacci 61.8% retracement of the ascent from 85.66 end of October higher low to 91.96 beginning of January high of year 2012. Crude oil remains under pressure of its recent high of 103.72 posted on 5th of January, as continues to descend lower, with break of initial support zone at 97.40.50, extending so far to 95.43 and currently testing 90 days moving average on the daily chart. This is also the zone of the previous strong support at 95.00, below which to open way for further weakness and attract a level at 92.70 higher platform of 19th of December, and also 38.2 Fibonacci retracement of the broader uptrend from 74.94 beginning of October 2011 low, and 103.72 beginning of January 2012 high. The studies are negative at this point on the daily chart and keep the downside favored, while narrower time frames are also keeping the negative structure. However, overextended studies might see some might signal some corrective action. 20 days moving average currently at 97.85, along with the lower high at 97.97 are expected to offer initial strong resistance. Before this, we have 97.50, the previous lows, so 97.50, 98 for now is acting as strong resistance, and likely is going to cap the near-term price action as the pressure remains on the downside. Only break above here and the regain of levels 99 and 100 would be easing the immediate bear pressure and likely opening way for test of our next barriers at 101 zone, where is also the main bear trend line currently at 101.42. Gold, the short-term price action shows yellow metal in the strong uptrend. The latest high 1761. Basically, the gold retested our initial our initial target at 17. Broke above 1756 initial one, and approaching the next one more significant at 1763, and also 1766 Fibonacci 61.8% of the broader down move from record high at 1920 down to 1522 low of 29th of December. Studies are positive and keep the upside favored for possible extension higher and test of next strong barrier at $1,800 per ounce. This is previous high, also psychological barrier break of which to confirm the double bottom at 1532 and 1522 and open way towards 1900, 1920. Overextended and overbought conditions on the daily warn of possible corrective action that might precede fresh rally, with the 90 days moving average currently at 1676 offering strong support, while 1716 and 1700 levels offer the initial supports. Loss of 1683, whereas the 90 days moving average would be risky at this point and would allow for a further reversal. However, golden cross of 20 days moving average crossing above 255 and 90 days gives the strong bullish signal for gold at this point.